Hey everyone, this is David and Parker with the Gellner team of Kidder Matthews. We're sitting here on the dock today to give a Q3 2024 market update.
Definitely. Well, yeah, happy to be here. My question to you to start is what's changed between Q2 and Q3?
Yeah, I think a few things that we should talk about. I think one of the main focal point items has always been the interest rate environment. As of this last Q3 quarter, we are now seeing, interest rates on the last few quotes that we've gotten have been in the 5.5% to 6% range, which is about a half point lower than we saw last quarter in Q2. So that's really helped drive some buyer demand, not only from the fundamental perspective of debt costs, but also just psychologically, the expectation being that rates are going to continue to drop. So we've seen a lot more buyer activity come into the market. Kind of the second item that we've seen has been the continued demand for multi-tenant shopping centers in the Pacific Northwest. That still remains the, prime asset in the retail category where we're seeing a lot of the buyer demand. Anything you're seeing that's been different?
I think that's the main part of the data, at least that we looked at, is this quarter as compared to the last four previous, multi-tenant sales have exceeded single tenants by numbers and by volumes, which used to be inverse, where you'd see single tenants, driving a lot of the, just the gross sales numbers, if you will. And then buyer pool, I know we've talked about that, but I think we've seen a lot of net new investors compared to, the kind of the known buyers or the known, active investors previously. Have you seen anything else on the buyer pool that's...
Yeah, I think another thing to mention is actually we are seeing a lot of multifamily properties hit the market, specifically in Seattle. So, we're retail guys. Why would we focus on multifamily investments or properties that hit the market? Well, simply because historically speaking, about 50 to 60% of the buyer pool for our retail category and the assets that we do sell comes from 1031 exchange buyers in the multifamily category. So speaking to our team, multifamily team at Kidder Matthews, year over year, comparing Q3 2023 with Q3 2022, they have 3 times the amount of available properties for sale. So expectations being kind of trying to cast forward and see what the future holds. Our expectation is we're going to see in Q4 and certainly Q1, hopefully a lot more 1031 exchange buyers. One thing to note, the last, call it 12 to 18 months, about 80% of the offer activity that we've received has been, groups that are not in a 1031 exchange, which historically speaking, it's almost the exact opposite, right? So getting an influx of 1031 exchange buyers, the expectation is going to be that, that'll only continue to drive market velocity, maybe help pricing out a little bit more as well. So it's good to see kind of the market on the multifamily side start to really move.
And, talking Q2 to Q3, I know we saw less properties hit the market this last quarter in Q3. What's your prediction for the future?
Yeah. Well, I would say, based on our team's activity and what we're seeing internally, we've been doing about 2 times the amount of broker opinions of values and underwriting for folks who are considering a sale. Of course, with this year being an election year, we're getting a ton of commentary of, hey, I'm going to wait and see what happens after the election. So I guess if I had to place a bet or look into the crystal ball and take a guess, I think we're going to see a lot more retail inventory hit the market next year, just solely based on the amount of, proposals and underwriting and what we're hearing from folks, getting ready to do something in 2025.
And what do you think that's going to do to pricing?
So I think that's, a nuanced conversation, right? So just to talk about pricing a little bit, the focal point in the last 12 to 18 months, again, has been interest rates. Everyone's focused on interest rates. I would say pretty definitively right now, based on our recent sales for properties $6 million and under, interest rates really are not having that major of an impact. It's really the two things that are having more of an impact on pricing have been just the current available inventory for retail assets in the Pacific Northwest, which is extremely shallow right now, especially on the multi-tenant side. And then the other item has been kind of the psychological change that we've seen the last year from the buyer pool, where they're exiting some of these other asset classes like multifamily, obviously office, where they've experienced some headwinds with inflation and maybe some rent decreases. Retail is kind of front and center in the viewpoint from investors as a safe asset to own, especially with the triple net leases insulating owners from rising operating costs.
And with the inventory on the market, I know you've had a couple clients in larger 1031s, 4, 5+ million. What have you seen on the single tenant inventory out there in that kind of larger price tranche?
Yeah, I think we really have to kind of segment the single tenant market. So, let's just take the 3 million and under price point, still very competitive with basically new construction development hitting a pause and really stagnating due to construction costs and interest rate costs. We haven't seen a lot of new construction assets hit the market. Those that have hit the market are getting near peak pricing right now, especially in that, call it 3 to 4 million and under price point. I would say if, the clients that we've worked with in larger exchanges, say $5 to $10 million, who are targeting a passive, investment property, frankly, that's a difficult asset class right now, simply because the main asset that a lot of those groups focused on and that was available has been the drugstore space. And the drugstore space is a mess right now with, the Walgreens news and the store closures that are coming, obviously Rite Aid and those challenges. So the investors that we've worked with, we've really helped guide kind of focusing on, some different asset types outside of the pharmacy space, or even just kind of splitting up their exchange, and instead of buying, $1, $6, or $10 million property, finding them $2 or $3 million properties that can fulfill their requirements.
Definitely. I've seen too with new construction on the developers who are trying to back into exit pricing. You have to have really high rents to get above 4 or 5 million, and it seems like they're being a lot more critical on if that's actually achievable. And then on the flip side, on the investors, I think folks are taking a much harder look at, can this tenant sustain a $300,000 a year rent as compared to some of those smaller tenants that it might be, high, 90,000 to 150,000 in rent.
Totally. And I would just add on top of that, for our developer clients and everyone listening, we've also seen, I would just say, 15-year lease is the new 10-year lease. So we've seen investors really focus and push back on a 10-year lease versus a 15. And, we've seen those changes in other parts of the country, specifically with tenants like Starbucks, where they've primarily always done a 10-year lease. They're starting to pivot and have to do a 15-year lease because the buyer pool is demanding in order for the developers to achieve, suitable pricing to make the projects make sense. You really need a 15-year lease. Obviously, triple net's good. Absolute triple net's better. So really, would suggest 15-year term. It's really helping kind of buyer activity and pricing a lot more than it has historically.
And rental increases too. I've noticed a lot is, before increase in year 6 or 7 to start out, and if it was even sub 10%, maybe 7 or 8, folks would be okay with that. And now significantly more scrutiny into making sure that those rental increases are coming every 5 years at a minimum.
Yeah.
And sizable, 10%, 12% in some cases.
Yeah, same kind of commentary as well. Like, if you're working a new lease, 7 or 8% increase every 5 years is not going to cut it. Got to be probably at least a minimum of 10 plus for sure right now, given the inflationary environment that we've seen. So yeah, those are some of the changes we've seen in the last, quarter or two.
Yeah. What are your predictions for 2025?
I think we're going to see a more active market. I think retail remains fundamentally very strong in our Pacific Northwest market, with interest rates lowering, and then again the multifamily side seeing a major increase in for sale properties. That just leads me to believe that we're going to see a lot more activity heading into 2025. If you're listening and you may be considering selling a property or two, right now, I know we're brokers and we're biased, but we really do believe that now's a good time to sell, simply because of those two main items: the interest rates dropping, but also just the available inventory. That is really a major, if you're a seller, you don't have a lot of competition out there for, quality assets in the Pacific Northwest. And so if we do see an uptick in listing inventory, call it Q1 of next year, that will have an effect or stagnate the pricing that we've seen.
Definitely, and I think too, supply is already constrained, and then price right supply is even more constrained. I think, even on the deals that are on market, a lot of those, you take one look at them and, it's peak pricing still that somebody's trying to, list at and just kind of fish, for lack of a better word. And I think that's probably going to get flushed out a little bit in 2025, where pricing is going to be a little bit more consistent, and the deals that hit the market are going to be priced at market or slightly above, but nothing, kind of the higher tranche of super aggressively priced properties, and then the actual properties that are poised to sell.
Absolutely. Absolutely.
Well, I'm thinking of anything else. Do you have anything, kind of high level thoughts on moving forward?
I think, one of the other things just to touch on real quick has been we've started to see some of the larger multi-tenant retail centers start to trade. I think the average cap rate for, call it 1970, 1980 vintage multi-tenant has been low to mid sevens. So that's kind of been a major change from the start of the year, where really that kind of 6 million, 10 million plus or higher shopping center properties, we really saw minimal to very few properties trade. And with those interest rates decreasing, that has really helped those properties start to move.
Do you think, in that higher price range, what are those buyers looking like, and what do you think those buyers are going to look like? Because obviously that's harder for a net new investor to come and take down a $15 million shopping center.
Yeah, I mean, actually, that's a great point. One of the major changes we've seen in just the buyer pool across price point categories has been a really major influx in first-time retail investors. And so, the two main changes have been, 80% of the buyer pool has been not in an exchange, and then the other change has been first-time retail investors, going back to that comment about, retail is viewed right now as one of the safer, if not possibly the safest asset class long-term to own, given our low vacancy rates and the triple net leases. And so that's been really interesting to watch, and I think that's going to continue, in my opinion, for sure.
I agree. And the other kind of similar but different side of that coin is I've seen a lot more folks who own retail, haven't bought retail in 5-10 years, focused really heavily on industrial or multifamily, now telling me they're willing to look at retail deals again. I've heard, better just for risk adjusted return, but it seems like a lot of folks, who only said, I've got my retail, I'm going to keep it, but I'm looking at industrial, are having a lot more conversations on our retail deals now again to come back to it.
It's retail's time to shine. I'll take it. If you're listening and have any questions on anything we talked about, or just want to chat specifically about your property, please reach out to Parker and I anytime. We're here to help out in any way that we can. Thanks for listening, and we'll see you on the next one.
Thank you.